Thank you very much, Kabir. Thanks a lot for the introduction. Good evening, everybody. Basically, we thought we will just take you through the opportunities in capital markets as such and the opportunities available for non-resident Indians in investing in Indian market as such. So small history. NSE, National Stock Exchange, is about 20 years old. We have come into existence in 1994. We started trading equities in 1994. Over the last 20 years, there has been a significant change in the way Indian capital markets have evolved significantly over the last 20 years. And we have seen a complete transformation of Indian capital markets from being completely physical and outdated systems to one of the cutting-edge technology-oriented and completely transparent and highly efficient set of market practices which have been put in place in the last 20 years. We are possibly one of the best in the world as of now in terms of technology, as well as the systems and the processes which have been put across both the trading, settlement, risk management, and the entire value chain, right from the time you decide to buy a security on exchange till the time you get those securities in your account, or possibly sell when you wanted to sell the money in your account. So the whole bunch of reforms have been put in place by the regulator as well as the exchanges, and we have seen a significant, complete transformation of Indian securities market in the last 20 years. Going forward, basically as an exchange, I just wanted to give a brief introduction of the exchange and its ecosystem. NSE, as already talked about, has set up the exchange platform. Simultaneously, we also looked at the capability of providing all asset classes for investors to kind of access and trade on. So on the main exchange platform itself, we provide equities, equity derivatives, debt, interest rate derivatives. The whole bunch of asset classes are available on the main exchange platform. Over and above that, we have created an ecosystem where other asset classes can get traded through our subsidiaries or joint ventures which we have set up in the exchange ecosystem overall. We have an exchange that trades commodity derivatives, one more exchange trades power. There's a clearing corporation. There is obviously a depository, which is the backbone of dematerialized electronic settlement. We have an index computation company which takes care of maintaining of the index. A whole bunch of technology companies which take care of our technology, because the technology is the backbone on which we have actually achieved the kind of penetration which no other exchange possibly could have done anywhere in the world. Right now, as of today, we have presence of more than 2 lakh terminals, 200,000 terminals across more than 2,500 cities in India, which is a significant penetration in terms of reach as well as ability to execute trades using whatever connectivity investors have, right from having a laptop with an internet connection or a mobile phone, a smartphone, or any other device which can connect to internet, and then they can place orders and see the entire chain of events from the time of order placement till the time that settlement is completed. So that's the kind of ecosystem which got developed over the last 20 years, which all of you can use directly from wherever you are to place your orders and monitor your trading activity. Again, the risk management is the backbone, and exchange and the clearing corporation have put together a series of risk management features in the capital market ecosystem with the help of regulator. It's one of the most robust risk management systems set up, possibly comparing to the best in the world. And the defining feature of Indian capital market, particular risk management system, is that it is done at the client level, and which is possibly not replicated anywhere in the world. That gives the additional comfort of ensuring that your settlements are happening on clockwork precision, and a complete settlement guarantee is available, innovation and netting. Multiple features have been built into the clearing corporation. An entire framework has taken care of the requirements of foreign investors, including NRIs as well as foreign institutional investors. The settlement guarantee fund, and each segment, basically from cash market to derivatives to FX derivatives, each segment has its own settlement guarantee fund. And the way and the settlement guarantee funds are subjected to kind of stress tests, which ensure that there is no failure of settlement at any point of time, despite significant volatility which we have seen over the last 5-6 years after 2008 global meltdown. Coming to basically, NSE, as I said, is a 20-year-old company, and from the time we have set up, we are the largest exchange in the country. More than 85% of the total cash market volumes have done NSE. Almost, again, 75–80% of the derivatives volumes, have done NSE, and currency is almost more than 50% happens. And we are one of the largest exchange in the world, not just in India. In terms of equity trades, we are #1 exchange in the world, and equity options, number of contracts traded, again, we are #1 exchange. There are multiple things. These are all achieved on the basis of a technology which takes care of the reach as well as the robustness, throughput, latency. We have set up a technology platform which can accept almost 200,000 order messages every second, and kind of robustness in terms of we handle on an average every day of 1 billion order messages. So it's a significantly robust and a reliable platform which has been set up, which ensures that your orders at any point of time during the trading hours, whatever number of orders come through, are handled properly, and you get the confirmations and the trades are executed. Coming back to the NRI's participation in the cash market, we have seen almost close to 100,000 NRIs have registered in the cash market. This number is not very big, considering the diaspora which is present across the world. The number is not very big. It's quite surprising that the diaspora is not really using the complete avenues which have been created by the government and the infrastructure which has been created in this country to possibly invest. We are seeing significant inflows of foreign money into India. FIs have been one of the largest contributors in terms of bringing in money almost since 2008, except for 1 year. There has been consistent inflows throughout this period, and they contribute almost about 24% of the total volumes. A significant chunk of foreign institutional interest is in India, but similar interest we are not really seeing from NRIs. As I said, about 100,000 registrations are there, and there's about 25,000 NRIs about trade in the market. The volumes are not really that great. There's huge amount of scope for further improvement in this area, and that's one of the reasons why we are here, possibly to kind of give you the perspective of how the trading is happening, what kind of facilities which are available, which will enable you to possibly use equity markets to leverage your savings potential, and also possibly diversify your portfolio. You must be investing in various asset classes in various forms across the globe, and this is one asset class, and India is a country which has a huge significant potential for growth going forward. And in terms of returns, obviously Indian ETFs are giving returns which are comparable to the best in the last 3–4 years. We really see it's one of the better performing markets. That's the reason why we are actually talking about the participation of NRIs in India. The numbers are not really, there is huge potential for improvement here. And similarly in the derivatives market, we have registrations again are around 60,000 registrations. The participation levels are much lower here. We're just seeing about 600 to 800 NRIs participating in the market. Again, as I said, this is one of the most liquid markets anywhere in the world. Possibly the number of contracts terms and options, index options contracts beat the CME volumes almost on every daily basis. So it's a hugely liquid market. There's significant amount of depth and width, and some of you who have the understanding of the market should try and participate in this market. It does give fantastic returns. Again, I really don't want to go into the nitty-gritties of how you set up your accounts and taking it forward. Obviously, most of you have already your bank accounts running. And if you want to invest in the cash market, obviously you need to open a DP account, and a bank account obviously has to be there in the first place. That nothing is going to happen. We can possibly touch upon some of these issues during the question answer session. So I'm not really getting into the details of what exactly you are supposed to be doing, and some of the asset classes particularly which I want to kind of emphasize is besides equities, you can invest in ETFs, including gold ETFs. There are multiple exchange traded funds available in India. And some of you who are very, very busy with your lives, wherever you are working, ETF is a fairly simple, straightforward product where you don't really have to invest in terms of your understanding or time. It gives market return. Supposing you take Nifty is the flagship index of NSE. There are multiple ETFs linked to Nifty. So if you invest in any of these Nifty linked ETFs, you will get market returns. So effectively what happens is you don't really have to worry about choosing a particular stock or timing a particular stock. If you start an SIP on a systematic investment fund, so basically most of you are used to investing in, say, putting in bank deposits, recurring deposits. Every month certain sum of money is pushed into a fixed deposit account. Similarly, you can set up a systematic investment plan on the ETF, and for a longer period across the board, there are a number of empirical studies as well as actual evidence of equities giving a significantly higher return compared to the fixed income return. Empirical studies kind of talk about on a 10-year period, the equity returns will be at least 700 to 800 basis points over the fixed income return. So this is one product which is available to you, and NRIs can invest in that. And there are gold ETF products which have been launched by various mutual funds. You can possibly, instead of acquiring physical gold, most of Indians, whether you are in India or outside, people tend to acquire gold. Gold is an asset which is looked upon as a safe haven. So if you are inclined to invest in gold, please look at gold ETF as an alternative, because it kind of reduces your requirement of holding physical gold in physical form. You can have, and at any point of time you want to convert the, into physical form, you can just sell the gold ETF and take the money and then buy required amount of gold with that money which is coming out. That is one of the products which we thought you should look at. And in fact, ETFs as a product category, government has used in March 2014. Government has used ETF route to divest almost 3,000 crores of public sector undertaking shares. In March 2014, they used an index of public sector undertakings, about 12 public sector undertakings. It was created as an index. Based on the index, they have divested 3,000 crores, and this CPS ETF, on which the returns have been almost 40 to 50% over the last 6 months period. And government is actually reconsidering coming out with another ETF using public sector undertakings. It should happen in the coming few months. Government has already started the process of appointing an AMC to handle this ETF. And government is also looking at divestment of almost 50,000 crores in the coming 2 to 3 month period. As NRIs, you can subscribe to those divestment processes which is going to happen. At least major companies which are being talked about are SAIL, ONGC, and Coal India. All three together should come to about 45,000 crores in the coming 2 to 3 month period. So you should look out for some of these opportunities which are coming from the divestment program, and you can participate, as I said earlier, in the derivative segment, which is open, and you can participate in individual stock-based derivatives like futures and options, or index-based futures and options. We have, as I mentioned, other asset classes which are available, currency derivatives, but NRIs are not allowed to participate in currency derivatives as of now. And if you have time, and if you have inclination, if you have expertise, you should look into equity derivatives. But if you don't have, there are safe products like ETFs which you should consider, which possibly you don't require to have the expertise of equity markets to invest in. Start an ETF, systematic investment plan on ETF, and possibly you get market-related returns without really worrying about the timing and picking up of the stocks as such. Again, these are basically the limits which have been allowed for NRIs as such. You can invest in debentures as well as in equity shares. Debentures, you can invest up to 5% of the paid capital. And in case of shares and convertible debentures, the limit is 10% of the paid capital. These are all again, rules which have been put in place. And the limit can be raised by the company concerned up to 24% by a special resolution. But we don't have to really worry about it. These numbers have not been achieved in most companies. There's a huge amount of headroom in almost majority of the companies for NRIs to invest. So choose your investment, or even these limits won't be applicable if you are coming through an ETF route. Even if you really don't want to pick up a particular stock, you should look at ETF as a route. So the Nifty-based ETF is allowing you to take a view on 50 of the best stocks in this country in one shot. You don't have to worry about investment limits. You don't have to worry about the pricing and everything. You just go and buy those ETFs and be happy with that, and you get a decent return based on whatever is the market return. It will not be giving outperforming the market, but you'll get the market return. On the derivative side, again, there are a few limits which have been put in place. In case of derivatives, again, 15% is more of a disclosure-related thing at the overall index contract level. But if you are getting into individual stocks, there are again specific limits. It cannot be more than 1% of the free float market capitalization, or 5% of the open interest in the particular underlying. I mean, all the equity contracts on an underlying. If you are really looking at individual stock derivatives, you need to worry about those specific limits. But again, these are most of your brokerages will be able to provide you the information on this on a regular basis. And yeah, these are basically, again, a lot of requirements. I'm sure most of the brokerages will be able to give you all these things. Don't worry about most of these areas except for the PAN card. The KYC process itself is not that complicated. You need to have PAN to participate in Indian markets. PAN is the income tax number. Other than that, most of other requirements are by and large what you would otherwise would have given to any bank or any broker. So most of these things are easily doable, and the documentation is not that complicated. SEBI has tried to ensure that the overall documentation is not that complicated as such. One more area where you possibly have to look at is particularly if you are picking up individual stocks. There are limits for foreign investment in individual stocks. So some of these numbers, I mean, the numbers keep on varying between anywhere between 24% to 100%. So if you're getting into a particular stock, and if you want to know whether there is headroom in a particular stock or not, because this limit is across NRIs, FIIs, everybody together. So in some of the stocks, the limits would have been exhausted already. This is monitored by the Reserve Bank of India, and Reserve Bank keeps on putting out stocks which are in the ban list. So if you are getting into particular stocks, you might want to actually check this one out first before going ahead and investing. But again, I come back to ETF point. If you want to invest in ETFs, you don't have to worry about all these things. Just go and invest and then be happy with that. Yeah, these are some of the base level precautions in terms of while you want to deal in a particular securities. Again, you have to check whether it is in the RBI ban list or not, and then ensure that the biggest hassle for most NRIs we find is that you can do on a repatriation basis as well as non-repatriation basis. You need to clearly give instructions to your brokerage. Just ensure that you don't give instruction for a security which is on repatriation basis, which you don't want to sell. You might want to sell on a non-repatriation basis. So those nitty-gritties you have to be really sure of when you are executing a transaction. Other than that, I mean, these are all regular kind of housekeeping, and you need to get base level clarity on what you are selling, and most of the time the brokerages will be able to help you in ensuring that your housekeeping is done properly. Beyond that, I don't think it's not rocket science as such. That's about it as far as overall investments are concerned. Again, coming back to India, I just wanted to reiterate the fact that India is a favorite destination from institutions across the world. We are seeing sovereign wealth funds from all major countries in the world coming in and investing in India. We are seeing pension funds from almost all major jurisdictions coming and investing in India. All major AMCs, FIIs are coming and investing in India. So you being NRIs and have a direct relation to this country, you should consider coming and investing in India and benefit from the kind of returns which Indian market is giving to the investors. that's about it. Thank you very much for the patient hearing. Thanks.
Well, thank you, Mr. Varanasi, for that informative section on National Stock Exchange and how the diaspora can invest in the securities market. Next, I would like to invite Ms. Natasha Shankar, who is the Vice President of Research in Yes Securities Limited. Ms. Natasha, please.
Thank you, Kabir. Thank you, Mr. Varanasi. So, good morning, good afternoon, good evening, depending on which geography you have joined us in from. We are representing Yes Securities here, which is the securities division of Yes Bank, which is India's 4th largest and one of the youngest banks in the country. We were incorporated last year, so we are a very young organization and we are a wholly owned subsidiary of Yes Bank. So Mr. Varanasi has taken you through how you can invest in India as well as all the risks that you will be facing here. We would talk about largely from the perspective of whether you should invest in India right now or not, which is a question which should be there in a lot of investor minds. So this is how the investment markets have actually performed. If you look at the chart on top, the Sensex as well as the Nifty are up by a good part of 31% and 33% from February 2014 itself. In fact, if you look at one-year returns, Nifty has been one of the best performance in the global arena. So a question that a lot of you would be asking yourselves should ideally be whether investing in Indian markets right now really makes sense or not, or is it too expensive, or is it going to go through a correction? So the answer to that is very simple. It depends on the fundamentals and what are the expectations that investors have. So if you look at the fundamentals are largely defined by valuations. In very simple terms, what is the price that you're paying? What is the value that you're going to get for the price that you pay? That in itself is, in investor terminology, without trying to get into very detailed discussions on that, it is called price to earnings ratio. So if you look at the price to earnings ratio all the way from January 2003, you can see that currently, that's the blue line, which is the current valuation, is trading much above its historic average. So this would give two questions to you, whether it makes sense to invest right now, is it too expensive? So the answer to that is very simple. Price to earnings in itself has two components in it. One is of course the price, which is the numerator of the equation, and the second part of it is earnings, which is the denominator of the equation. Now the only way it can correct to the historic averages is either one, the price corrects, that is the prices come down, alternatively the earnings go up. So to answer the question, we try and go ahead. So typically, if you go back in history, the earnings growth in India for Nifty has tracked the GDP growth very, very closely. So to answer our first question, whether the earnings are going to go up or our price is going to correct, we have to answer whether GDP is actually going to go up or not. This is a heat map that we have of the economy. Green signifies that things are turning for good, with the better, things are turning around, and red signifies that things are actually not becoming better. So you have a danger signal, so as to speak. So if you see that in January we had more reds than greens, which meant that the economy was definitely not out of the woods. But moving forward to July, you can see that most of it is in green. So these are just the breakdown of all the economic components, everything that makes up the economy. So you have the core industry, you have your bank credit, auto sales, thermal power generation, air passengers, cargo. So typically everything that indicates whether the economy is improving or not. More green seems to suggest that yes, things are turning around and things can be expected to turn around. Now we at Yes Bank, we are expecting the economy to go up in the FY15, economic growth to go up. Not very significantly, yes, because there is a lot that needs to be done, but based on the reforms as well as the discussions with what we've had from other market participants, we forecast that the economy should grow by about 5.4% in FY15. And this would largely be driven by the growth in the industrial segments. So if you go back and if you actually check out the gray bars is significant the growth in the industry. So if you see FY13 and FY14, they've been abysmally low. So in FY15, we expect the growth to come largely from the industrial side. And if you remember, if you see this particular graph where we have the heat map, you can see that industries should be driving the growth. But the question, of course, is that eventually stock markets are made up of companies, and whether the improvement in the economy is actually coming across as an improvement in the industry? The answer to that, sadly, is no, not at the moment. If you look at it historically, the margins are below average, your net margins are below average, your returns on the net worth or the equity as it can be called, they are below average. Debt on the other side has gone up significantly. So what is it that makes us so hopeful? The thing that makes us hopeful is that the concept called reversion to mean. If you come back to reversion to mean, eventually everything should come back to average. And given the pro-reform government that we have in place at the moment and the kind of announcements that the government has been making, we expect things to turn around. And we've also spoken to a lot of companies as well as market participants to understand that, yes, that turnaround is happening. So that gap that you see between the red line and the blue bars, that is the gap that we can expect the companies to make up in earnings. So that means things are going to turn around pretty soon, which makes it very attractive makes India a very attractive place for investments. So which are the sectors that we think that would be delivering these higher returns? If you look at the way the sectors have performed over this period of time, you can see that the stocks in the auto, banking, pharma and IT, they have actually outperformed pretty much every other sector which is there listed over here. But again the question comes back, will this performance be sustainable? That depends on the fundamentals of these sectors. So this is how these sectors have been. We've just tried to classify them for you into two buckets. One which has seen their returns actually deteriorating, and another set which has seen their returns actually improving. So you can see that actually the sectors which have outperformed the broader markets, those are the ones which have actually seen the returns coming down. But the ones that have actually been delivering higher returns, those are not the ones that have been outperforming the sectors. So to answer again, the question again comes across, why would you want to invest in these sectors given that the returns have actually been declining? So here is our response to that you should look at two sets of stocks. One is of course that you look at those which are capable of participating in the economic recovery, which we think is going to be coming across very soon. Not in 1 month or 2 months, but yes, over a period of 1.5 years, we can expect economy to revive based on all the indicators that we've been seeing. But at the same time, you have to be cautious. You cannot ignore the stability of higher returns which are being provided by certain sectors. So here we've just tried to come up with 5 sectors which we think would do well. IT and consumers, the first and the last one in this, are the 2 sectors which have been delivering higher returns to their shareholders in terms of return on equity, in terms of the dividends that they've paid out, as well as the stock market returns that they have delivered. And the other 3 are top pick sectors to participate in the event of an economic recovery. So this is how autos are panning out. If you actually see, the sales growth has come down, but the margins are still quite stable. They have come under pressure. It's not that they have not come under pressure, but the margins are still typically quite high. The returns on net worth are quite high. Therefore, they should be the first ones to participate in the event of an economic recovery. Because it's just the growth part which is missing. So they should see a pretty sharp pace of recovery. Coming to the banks, banks have been under pressure. Of course, if there is a credit constraint in the economy, even today you heard the RBI governor present his monetary policy, bi-monthly monetary policy. So if you have heard the monetary policies given out earlier, the RBI has been increasing the interest rates or tightening the monetary conditions in the economy. And the reason for doing that has been the higher inflation levels that we've seen. But since things seem to be improving, the inflation has not significantly come down, but yes, it is coming down the glide path of RBI, that is a projected glide path given by RBI, wherein it should taper down by next year, and the year after that he even expects it to come down to about 6%. So once you start seeing the economic recovery coming into the economy, we would see an uptake of investments, that is investments would revive in the various sectors, which in turn should lead to a higher offtake for credit, which would lead to the benefit for banks. So post autos, we should see some kind of a recovery coming in for banks. But the biggest concern for banks has been the asset quality. Because of the way the economy has been for the past few years, a lot of companies have taken on a lot of debt. A lot of them have seen their own performance come under pressure. which is why they have had difficulties in servicing the debt. Now, as a bank, your business is to give out loans, and if you're not seeing that recovery coming in, your asset quality starts worsening. But again, a lot of banks have taken the measures to try and control this. They have taken the measures to try and improve the asset quality, which is why we expect banks to do well as well. Now, here is the sector which most of the people have tried to avoid till now, and that is the infrastructure sector. If you actually look at the FY14 growth, that little bar, that is actually the sales growth that has come in for the entire sector. What has happened with the infrastructure sector is that there have been a lot of projects which have been held up on the part of the government. Some of them have been held up on the part of the companies itself because they do not have the finances to service them. So as a result, the infrastructure sector has suffered. There were policy bottlenecks, there were certain economic bottlenecks, which there was also a constraint on demand, the tighter monetary conditions, everything combined, it hit the investment cycle in the country. But with a pro-reformist government that we have in place, we can expect things to revive. Things are reviving. There has been an offtake for, there have been certain projects which have received their clearance in the recent past. Companies are more keen to invest. However, they are not very keen to invest immediately because there's a lot of mess that needs to be cleaned up. Therefore, we can expect infrastructure sector to revive, but that's not going to happen very soon. In fact, it's going to be a much longer term bet. So if you look at the financials of these companies, you can expect them to come back to average, rather revert to mean over a period of a good part of 1.5 to 2 years at least. So this would be the longer term bet if you want to look at the economic recovery. And again, coming back to our original argument on IT and consumer goods, that these are the sectors who have delivered high returns as well as are seeing their earnings grow. Yes, you can argue that in a case of FMCG, the earnings growth has actually come off, but this should also be seen in light of the rest of the sectors. Despite the fact that they've come off, they've actually outperformed the other sectors in terms of delivering earnings growth. So which is why we feel that this is a very healthy sector to invest in. So the things to remember, of course, that you have to be cautious when it comes to investments. If you do not have the time to pick up a stock and invest in it, or the time to look at what kind of returns it's giving, then yes, as Mr. Varanasi rightly said, that you should be looking at ETFs. But if you're looking at stock-specific investments, you can definitely look at these sectors. And overall, India is a very healthy place to invest in. As you can see that there are certain green shoots which are coming onto the economy, suggesting that the worst seems to be over for the economy. And this is a very good time to invest in India, and we hope that you do invest in India as such. Thank you.